Good day, Dr. HANITA. Welcome to our presentation on debt, risk, and capital structure. Insights from emerging markets. Without further ado, let's begin the presentation.
Good day, Doctor. I will start our presentations with the background of study. Over the past century, global trade has been a transformative force in shaping the world economy, overcoming challenges like the World War I, the Great Depression, and post-World War II recovery. Trade continued to surge after the establishment of United Nations Conference on Trade and Development, allowing developing countries to significantly increase their participation. Globalization has further intensified with milestones like China's entry into the World Trade Organization in 2001, which elevated the competition and influenced corporate financial strategies. So, capital structure is crucial in corporate financial management. Most firms incorporating debt to fuel growth rather than solely relying on equity. Debt offers benefits such as tax-deductible interest expenses, which lower a company's cost of capital and enhance profitability. However, excessive debt can lead to financial risks, including default and bankruptcy. In China, the real estate crisis highlights this risk as firms in these sectors accumulate unsustainable debt levels. This underscores the importance of balancing the benefits of debt, such as tax shelves, against the potential dangers of over-leverage. Next, emerging markets like the G20 economies, now accounting for one-third of global GDP, present both opportunities and challenges for corporate growth. How, unlike developed markets with sophisticated financing structures, emerging markets often rely on internal financing and short-term debt to mitigate risk. For example, Serbian firms prefer low debt ratios to manage volatility, reflecting a cautious approach. Despite difference, emerging markets are gaining prominence. Experts predict emerging market debts, especially in hard currencies, will outperform global equities with lower volatility over the next decades. Malaysia, as a key emerging market, continues to adapt to global economic shifts. Its inclusion in the BRICS Plus bloc in 2024 enhanced trade access, yet challenges persist. Post-COVID recovery, supply chain disruptions, geopolitical tensions, and inflation have dampened business demand. Workforce shortage and rising costs further compound economic pressures, reflecting the global complexities faced by emerging markets. In conclusion, this dynamic of global trade and capital structure underscore the need for strategic financial management. Balancing growth opportunities with risk mitigation is essential, particularly in emerging markets like Malaysia's. As globalization advances, adapting to these complexities will shape the futures of global economic landscapes. So that's all from me. I will pass to the next presenter.
Good day to Dr. HANITA. My name is Lim Wen Jia, metric number 284889. 2.0 Current development of the debt in Malaysia or regional area. 2.1 Corporate debt level. The Asian plus 3 region include the Asian country with China, Japan, and South Korea. This country has been a steady increase in total debt to GDP ratio since the global financial crisis. As we can see, the corporate debt to GDP ratio remains higher in Asian plus 3 compared to the other regions. This shows a significant reliance on debt financing among firms. 2.2 Debt at risk. As we all know, interest coverage ratio (ICR) less than 1 is indicate that the firm earnings are insufficient to cover its debt interest obligation. As for mid-2022, 17% of Asia corporate debt was held by firms with an ICR below 1. Furthermore, an additional third by firms with an ICR between 1 and 4. This distribution underscores the vulnerability of a substantial segment of corporate debt to financial distress. 2.3 Capital structure determinant in Malaysia. A study that analyzed 827 listed non-financial firms from 2008 to 2017. It identified that profitability, firm size, asset tangibility, growth opportunity as the key determinant of leverage. In the end, the findings suggest that more profitable firms tend to use less debt. On the other hand, larger firms with tangible assets are more inclined to leverage. 2.4 is the recent development in Malaysia. The stable of political and economic policy have gained a lot of foreign investment to invest in the Malaysia debt market. In July 2024, which is shown in the figure, foreign investors invested up to 1.75 billion to the Malaysia debt market. It is the highest in a year, and it is reflecting the confidence of the foreign investor in Malaysia's economic trajectory.
Good day, Toto. My name is Yap Zhi Xin, and my metric number is 285516. Now I'll talk about the opportunity of corporate debt level in Malaysia or regional areas. So the first opportunity that I want to talk is give the business in ASEAN a chance to get money for growth. Why I say so is because in ASEAN's partially country, they are show higher corporate debt ratio than other global counterparts. In this case, many of this economy, particularly Vietnam, Indonesia, because they are in need of rapid expansion, so the business are more strategically on using debt to fund growth initiative. Although it has shown having reliance on debt financing, but it has considered as a transformative opportunity for them because it gives the business a chance to get money for growth. Next, the opportunity of debt areas is it can enable more highly settled to access diversified source of funding and reduce their dependency on indebtedness. Why I say so is because when high-risk sector like SME expanding access to alternative financing such as equity markets and governments loans, that it has helped them move away from over-reliance on debt. Thus, we conclude that diversifying funding sources will not only stabilize high-risk sector, but also enable them to reduce their dependency on indebtedness. Moreover, the opportunity of capital structure is it gives the big company in a chance to use that market smartly to pay for growth and development projects. For example, in Malaysia, mostly the bigger company who usually have physical assets like manufacturing or real estate, most likely to tap on that. For example, building infrastructure in Malaysia could get a lot of help from that financing if they have a strong governance and risk management measure. So this fact has proved that usually the big company in ASEAN have a chance to use that markets very smartly to pay for their growth and development project. The last but not least, the stability of Malaysia's political and economy has created a high opportunity of attracting more foreign investment to come in. As we know, foreign investment has become an important factor for a country to grow. In Malaysia, in 2024, Malaysia has emerged as a more attractive place for international debt investment as we have received a highest amount in a year, around 1.75 million in foreign investment in its debt markets. So it shows that global investors are more trust the country who have economic stability.
Good day, Doctor. My name is Chong Yan Tim, metric number 285261. Now, I will talk about some of the challenges of issuing debt in Malaysia, the region, and globally. I will cover economic crisis, pro-economic growth, mismatch of debt with its growth in the real sector, and the impacts of global interest rate. Let's start with the economic crisis. Debt in ASEAN plus 3 countries has been rising, especially after the global financial crisis. By 2020 to 2022, the debt to GDP ratio in this region exceeds 250%, making it one of the highest in the world. Malaysia is no exception. Over the years, our national debt has grown significantly, especially during COVID-19 pandemic. Back to 2011, Malaysia debt to GDP ratio was right by 50%. By 2024, it reached 65.6%. What does this mean? Well, as that increases, the government has to spend more money to service it. This reduces the budget available for other important areas like healthcare, education, or development. It also limits the government's ability to adjust its fiscal policy. To manage this better, fiscal policy needs to align with debt strategy to ensure long-term sustainability. Now, let's move to slow economic growth. Malaysia's GDP per capita has grown over time, but it do not keep up with other countries like Poland and Croatia. After 2010 and especially after 2016, these two countries saw strong economic growth, but Malaysia growth slowed down, showing weaker progress. This slower growth creates several challenges. First, investors lose confidence, and it is harder for the country to recover economically. Besides, slow economic growth will lead to higher debt level. When debt grows faster than economic growth, it becomes harder for the countries to generate positive returns and attract investment. Next, let's talk about debt mismatch. For debt to be manageable, it should match growth in the real economy for areas like consumption, government spending, and production. When debt grows too quickly without real economic growth, it disrupts stability. This can lead to lower credit ratings and challenges in repaying debt. Finally, global interest rates. Rising global interest rates are another challenge. When rates go up, borrowing becomes more expensive for governments. To attract investors, governments must offer higher bond yields. This increases the borrowing costs and reduces the government's financial flexibility. In the long term, this makes managing debt even harder.
Hello, my name is Alyson with metric number 28849. I'm going to present impacts of debt, risk, and capital structure in Malaysia and globally. The size and structure of Malaysia's bond market reflect its importance in financial market, and Malaysia's bond market has been valued at 2 trillion as in December 2023. In Malaysia's market, most of the business relying on debt instrument to fund a company operation and business expansion because of the cost effectiveness such as tax incentive and also structural development of the corporate bond market. Although Malaysia's bond market is more stable compared to other financial instruments, but the risks such as interest rate volatility, currency fluctuation, inflation, global economic fluctuation still exist. It exposes huge uncertainty to foreign investors who buy bonds denominated in ringgit. According to BNM, we remain as the biggest global issuance of Sukuk, positioning Malaysia as a global leader in Sukuk market. Some infrastructure projects such as MRT development largely financed through Sukuk, shown its importance in national development. Its success are also contributed by the regulatory support and active engagement from institutions such as BNM, Securities Commission Malaysia, that assist in safeguarding transparency, credibility, and innovation within the Sukuk ecosystem. Comparing Malaysia's bond market and Indonesia's, the volatility of Indonesian rupiah also exposes high risk to the investor, which make bond yield high sensitive to external shocks. In comparison, bond market in Malaysia benefits from a well-diversified debt structure and more balanced background of investors, which help in reducing its sensitivity towards external shocks. Another emerging market, which is Brazil, faces challenge of the macroeconomic instability such as high inflation rates, political turbulence, and inconsistent economic policies lead to the incremental in-risk premiums of the bond, which in a way discouraging both domestic and foreign investment. In contrast, Malaysia practices a clear regulatory and investor-friendly policies to maintain fiscal stability and improve investor confidence in bond investment in Malaysia. Meanwhile, comparing Malaysia's bond market with China, which is the largest in emerging market, China's bond market faces issues such as lack of foreign investors in bond market due to the concerns about transparency, uncertain regulatory, and the currency risk. Comparing with China's, bond market in Malaysia is smaller, but it's able to attract foreign investors because of the stable regulatory framework and investor-friendly policies compared to China. Besides, Malaysia has more diverse and innovative financial instruments such as Sukuk that not only attract Sharia-compliant investors, but also strengthen market resilience. On the other hand, bond market of China is heavily reliant on state-owned enterprise, which increase investors' concern in credit risk. That's all from me. Thank you.
My name is Teh Xue Ling and my metric number is 287584. For policy recommendation, we focus on 5 points: macroeconomic stability, investment and credit growth, handling economic crisis, addressing global interest rate impact, and global best practices. The macroeconomic stability is fundamental for addressing slow economic growth in emerging markets. Policymakers should establish clear and achievable macroeconomic goals, aligning fiscal, monetary, and exchange rate policies to support growth, control inflation, managing external debt, and strengthening of the international reserve. Inclusive development is equally vital. Governments must address economic and social barriers to enable broader participation in the economy, particularly for the marginalized group. These measures foster equitable growth and provide a sustainable approach to managing national debt levels. The relationship between investment and credit growth must be carefully managed. While higher credit growth stimulates investment, excessive expansion risks financial instability. Structural reforms can balance these dynamics by adjusting constraints as needed. Developing technological and digital infrastructure is also critical to fostering investment. Bridging gaps such as rural broadband access and harmonizing regulations with international standards will encourage public and private investments. These efforts create a foundation for sustainable growth and debt management. Lessons from past crises, such as the 2008 financial global crisis, offer valuable insights. Relaxing monetary policy can provide liquidity, while fiscal investment should target high-growth projects, such as the infrastructure and climate adaptation. The regional cooperation through free trade agreements strengthen the economic resilience. These coordinated measures stabilize the economy during downturns and lay the groundwork for sustainable growth. Rising global interest rates pose significant challenges to emerging markets. Governments should enhance fiscal resources by eliminating inefficiencies and building cash and foreign exchange buffers. Establishing precautionary credit lines and conducting stress tests are essential for identifying vulnerabilities. These measures enable targeted interventions, ensuring resilience to external pressures. Global examples illustrate effective approaches to debt management. In China, policies addressing corporate asset debt mismatches, including increasing the cost of debt financing and restricting access to long-term credit for high-risk businesses. Europe emphasizes financial stability through liquidity buffers, stress tests, and conservative redemption terms. These strategies mitigate corporate debt risks and demonstrating the value of structured context-specific solutions. Robust macroeconomic policies and balanced debt management are critical to fostering stability and growth in emerging markets. Addressing systemic vulnerabilities and encouraging sustainable credit growth enhance resilience to external shocks. Future research should explore alternative financing mechanisms and sector-specific dynamics, particularly within Asian countries. Such investigations are essential for optimizing capital structures and achieving long-term economic stability.